Big banks brace for losses, loan defaults skyrocket, unlimited money creation for bailouts, who will pay, and the economy is in ruins. Hey everybody, it is JJ. You're watching Bolt to the Bus. It is Wednesday, April 15th. I hope everyone is well. And I wanted to bring you some news today that I feel is being very underreported, so I appreciate you joining in. We're going to have a lot of important stuff here, a lot of charts to look at today, and a lot of data to discuss. Let's get started. And also, real quick mention, if you like the information that we provide you here on this channel, please look at the link below. It is a Patreon link. You can support this channel, help keep us alive for as little as $1 a month. It could definitely help keep us stay afloat. Please check the link below. We're going to start off right here. This is a chart of banks' loan loss reserves to total loans. Now, we've mentioned here on this channel numerous times how banks only keep a fraction of reserves in their coffers to compare to the amount of loans that they are lending out. It's called a fractional reserve system. And if you look back before the financial crisis, you would notice that the reserves, and these are some of the too big to fail banks, some of the biggest banks in the United States, the reserves kept getting lower and lower and lower. It was about at 2.5% there for some banks, and ultimately it went down to 1%. So that meant for every dollar that they had in reserves, they could loan out $100, right? Can you imagine you having those same powers? You can loan out $100 for every dollar that you actually have, and you get to charge interest for it, anywhere from 4%, maybe a mortgage, up to 20% and beyond if it's a credit card. Imagine yourself in the same shoes as a bank, how much money you could make. And then you can turn around and use those profits to buy back your own company's stock, and that way you as an insider can get even richer and take advantage of this free money that we have flowing through the system that typically benefits the people at the top and the banks the most, while us citizens, us working class people down here, we do get a trickle down, maybe a few breadcrumbs from the king's table, so to speak. All right, but here was the reserves, many banks down around 1% before the financial crisis. But when default started to spike, when consumers started not being able to pay their mortgages, becoming more late on their credit card payments, and skipping payments entirely, well, we saw the banks begin to panic and brace for the fallout, in this case the defaults. And we saw the banks then start increasing their loan loss reserves. And we see with a couple of the too big to fail banks, they went up to 5 or 6% on those loss reserves, which is still outrageously low considering it's the fractional reserve system. Right, if this was a 1-to-1 ratio, banks would never need a bailout because they could only loan out money that they actually have in deposits. And you would still have the risk of a bank run where people take out all their money because of some sort of panic, and then banks would still be in a tough position because they still wouldn't be able to cover their loan losses if that were to take place. But you do see what we're getting at here. Banks did brace for the fallout once they saw the defaults start to ramp up, once they saw the late payments start to increase. And we saw here, starting in about late 2007, early 2008, banks started noticing this. Fast forward to today, and just in the past couple months, we now see banks again bracing for the losses, because what happened, we talked about this in our previous reports, what is happening is people are skipping their payments, they're not able to make their credit card payment. We have a record-breaking unemployment number that's hit over the past few weeks, 17 million, and it's going to be beyond 20 million, probably 25 million here in another week or another 2 weeks. And I see it's going to continue to break records. But before we saw this data here, there was a few different theories floating around. One theory is that banks know that they're going to get bailed out with endless money from the central bank, from the Fed, especially now since the Treasury and the Fed are basically intertwined. There was this one theory that banks are not going to have to increase their loan loss reserves is because they know they're going to get bailed out. That was one of the theories. And along with that theory was the thought that banks are going to continue to lend because they know, again, they're going to get bailed out. There's unlimited money available. It's printed out of thin air. It's not backed by anything, therefore it's unlimited. And then some people say, no, JJ, that's crazy talk. Banks, they can't just print unlimited amounts of money. And the central bank, they can't do that either. There's regulations, there's guidelines. Well, no, there's not. No, it's called a fiat currency. It's not backed by gold. You could say it's backed by oil. But see, that doesn't limit the amount of reserves they can print. Right? When was the last time you saw a cash to oil ratio? Right? It doesn't work like that. It's much different than having, let's say, a gold standard, where only a certain amount of cash can be created based on the amount of gold you have in reserves. Right? It's completely different. So anyone telling you that the dollar's commodity based or backed by oil, well, go ahead and post down in comments what the reserve requirement is for the oil to cash ratio. If you find it, I'll be amazed, because I've been researching this for over a decade and I've never seen that. So if you put it down there, I'll be amazed. But let's look at this chart again here. Banks are preparing for big losses. They're ramping up their loan reserves, and they're also tightening their lending. So both of those theories previously, that the banks are going to continue to lend even though people are stopping paying their mortgages, is starting to be disproven. And if this continues, we're going to see massive deflation. You see, the other theory is that banks were going to tighten up on their lending, and they were going to make it much harder for the average person to get a loan by raising the lending or raising the borrowing requirements to say 20% down payment or having at least a 700 credit score. Well, that's what happened. That's what's happening right now at some of the banks. If you look at our housing bubble report, the previous video that we put out, we talked about that. Banks are tightening up. They're trying to boost their reserves to brace for these losses. So something is happening behind the scenes where banks are not so sure, they're not so confident that the Fed's just going to be there with unlimited bailout money. And then you may ask, well, if the banks are going to get unlimited bailouts, why would they pull back on the loans? Why not just keep giving out loans? Well, maybe they want to cause deflation. And what happened the last time we saw falling prices in homes and stocks? Well, we saw a lot of the rich people get much richer. Homes, the ownership of those homes, millions of homes, got shifted from middle class, working class individuals to investors and corporations and large financial institutions that became landlords. And this could be what is on the horizon now. Banks are going to pull back, allow deflation or cause deflation, and add on top of that the millions of job losses. We're going to see deflation, and we're starting to see it already. Home prices, the asking prices anyways, are starting to come down in many major cities. So the endless lending theory and the hyperinflation theory is starting to be disproven. Now we'll have to see what happens. No one knows exactly what the government's going to do. They could come in and say the banks have to lend to everybody. The banks have to loan out endless loans, just like they get endless liquidity from the central bank. Right? Nobody has a crystal ball on what the government's going to step in and make happen, but we do see the trend so far. And it's interesting because there's been signals out of Steve Mnuchin, for example, that the Treasury is going to be providing unlimited liquidity. And Powell and the Fed they have previously also stated this. Here's an article here just a few weeks old. Fed saying aggressive action is needed, starts unlimited QE. So ask yourself, how can something be unlimited? Well, it's pretty simple, and a lot of people still do not understand this. They still think that we need to raise taxes, and they think that the working class ultimately is going to have to pay for this. Well, ask yourself, if they can create unlimited amounts of money and they can provide unlimited QE as they've admitted themselves, you might want to rethink that theory. Right? So again, to the right of the chart here, we are now starting to increase, the banks are starting to increase the loan loss reserves, just like at the beginning of the financial crisis. So this is financial crisis 2.0. Could be Great Depression 2.0. I'm not trying to be a fearmonger here, but if these jobs do not come back, and I feel like many of the jobs are not going to come back, this is what we could be headed into. And we've already seen how unprepared most of the U.S. population is, with people waiting for hours for a bag of food in these food lines. Compared to the Great Depression, people are much less prepared now. We have more people packed into big cities, less people that are self-sufficient, less people that grow their own food, And this is why I say prepare for Great Depression 2.0. I'm not trying to scare anybody, and I hope it doesn't get that bad, but it doesn't hurt to prepare for the worst, right? So aim for the best, hope for the best, pray for the best, prepare for the worst. And according to the banks, we are headed into something bad because they are bracing for big losses. And based on what the reserves are telling us, this chart is telling us that the banks are not so confident that unlimited bailouts are going to be available. Right? So loan defaults are skyrocketing. We've talked about that in a few previous reports. For example, 2 million people did not pay their mortgage here so far in April. That's likely to get a lot higher. That number is going to increase here in the coming weeks. And unlimited money for bailouts, well, who's going to pay for it? Well, what they want you to think is that someday we're going to have to increase taxes to pay for all this. You see, they don't want you to know that they can create unlimited money. But the cat's out of the bag. The Treasury, the Fed, they've both admitted that now. They've said unlimited. They say whatever it takes. That's another phrase that we've heard, whatever it takes. Also letting us know that it is unlimited. But even before they came out with those phrases, they kind of let the cat out of the bag or revealed what's supposed to be a secret. We knew that years ago. We've been talking about this for years. But it is interesting that they're now actually using the verbiage that they have this unlimited amount of money. So now that this information gets out further into the public, into the minds of the masses, hopefully we're going to start seeing more people push back and ask more questions. Hopefully the mainstream media, the big news corporations will start covering this. I kind of doubt it, but I do hope that more people and the media start asking these questions. Who's going to pay for this? Well, who has the printing press? That should tell you that who should pay for it. And I deeply apologize. I'm going to have to hit this last bullet point in our next video. I've got an appointment that I have to go to in just a few minutes here, so I apologize. We'll hit that in our next video. Please give us a thumbs up if you like what we talk about. Link down below to help support the channel. I hope you're well, hope you're staying prepared, and I hope you're mentally and physically prepared for the economic downturn that we are in, and that could get much deeper and much harder. But if we stay in the know and stay prepared and stay on top of things, I think we'll come out on top of this, maybe even stronger for those of us that are prepared and that are keeping our heads above water and keeping our eyes on the real information here. Thanks everybody for watching. Bye for now.